Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. So today I have with me David Berneman with Golden Bee Properties. I've known David now for a handful of years. He's one of our kind of early clients with our investor management software. He's an early adopter mindset, a lot of fun guy to be around. Golden Bee Properties recently became a Valueadd verified gold member, I believe. So they're definitely all in, and we're super excited to have them be a part of what we're doing. And so David, why don't you share with us a little bit about how you got into real estate? I know it's a bit of a family business, and you guys are hardcore real estate guys and live down in Southern California and have been doing this a long time.
Yeah, no, thanks for having me, Lance. I really appreciate it, and we're happy to be part of the Valueadd family, now gold member status. So we're very excited about that. I think you guys have been putting on a really good platform for sponsors like ourselves to get out there and kind of show the world that we're legit.
Yeah.
Yeah. So to your question. So yeah, we're a family operation. Got my father involved, sister, brother, everybody's involved in some capacity in the business. I started about a decade ago, and just sort of serendipitously, various family members had things going on in their lives that made it work pretty well for us to kind of congeal and build an investments platform and put together a vertically integrated property management company and now construction company, and we have our own in-house design services. So we try to put all of our expertises together, and it's gone pretty well. So yeah, we've been focused on it for the last decade and focused here in primarily Southern California.
Yeah, very good. So I know for you guys, you've kind of got an interesting way that your buy box and what you look for, and it's very specific. And even the business plan and the things that you do to the assets post acquisition to sort of force appreciation and add that value, I think is somewhat unique. So maybe you could share a little bit with us, kind of that high level, your sort of investment philosophy, or kind of what it is that you're hunting for. I know it can be it can be challenging, obviously, to find what it is that you're looking for at the price point you're probably willing to pay, but maybe share with us kind of what that looks like.
Yeah, so we have a pretty heavy lift value add strategy. I'd say there are a lot of folks out there who do value add, but it's mixed bag of different types of value add, and we go kind of heavier on the spectrum, bringing buildings down to the studs and bringing them back to life. And so that's kind of been a niche for us in this sort of mid-market space, primarily again here in LA. Purchasing anywhere from a 10-unit apartment to a 50-unit apartment, and doing that full kind of bandwidth of bringing these buildings back to their glory days. A lot of these buildings were built in the 50s and 60s and 70s, and trying to kind of bring them back to life after a lot of deferred maintenance. So that's sort of our overall agenda. Some buildings kind of go on the lighter side, some buildings are ground up and go heavier, but our niche is kind of that mid-market heavy value add space.
And so what do you find? I mean, I know that I've had other guests on, that invest in Southern California, and it seems like it can be harder to, create cash flowing assets. So is part of that strategy is that's sort of your way of getting it at the right basis, so that you can actually get it to a point where, by the time you've done the renovation, like it actually will cash flow? Is that kind of a part of it?
In part, yeah, it depends. With rent control also and stabilization that we have here in LA, it becomes a sort of nuanced thing where we got to get into a building and look at it in particular and see if whether or not we can actually take this building from soup to nuts and do what we want to do. So there's rent control involved, so that is one component of it. But yeah, for the most part, I would say, to answer your question, it's about bringing the cash flow to a reasonable level. So for example, in some of these instances, we may be looking at a building where the in-place cap rate may not be that relevant. It's not that important. It's more about the in-place basis or the in-place cost per unit, because we know that we're going to bring an entirely new tenant base in that's paying market rent. So at that point, we're solving for a cap rate that's a future cap rate that we can get into at a later time once we've stabilized the building. So yeah, for the most part, we kind of look at it in that way, where we're trying to figure out how to get a land basis and how to get a cost basis that makes sense for us to then go and do the work and then bring it to a reasonable cash flow.
And do you guys see yourself then too as just more of long-term hold guys because of that? Meaning that if you can bring an asset back to its glory days and obviously is well located and you're at a good basis cash flow, I mean, a lot of syndicators, especially in markets like Texas where there's a lot of activity, a lot of trading of hands, right, between owners. I mean, is that how you kind of see it too? Is like, okay, well, we go through all this effort. If we had our druthers, we sort of don't want to sell it, or how do you deal with that?
Yeah, no, it's a valid point. In years past, we have had the ability to flip buildings, so to speak, have a 1 to 3 year hold, fix a building and sell it. And there's been an active environment for that. I think as COVID hit and as kind of we've grown in our trajectory, we've realized that definitely that long-term hold strategy is really the way to go, especially given property tax basis and a few other things. It just makes sense to be able to keep these assets for the long haul. And to that end, during COVID, actually in 2020, we completed a recap of 8 buildings where we took a few buildings that we had already in place and we recapitalized them. And one of the prime impetus for that was being able to hold on to the assets. They've gone through their life cycle with the existing investors and the existing LPs, but we didn't want to sell them. It just didn't make sense. So it was a way for us to go ahead and actually get the buildings and keep them for the long haul. So that was the main reason for this recap. And yeah, to that end, we do see the future being sort of more long-term holds.
Yeah, and I know that you guys are recently looking to expand into Nevada markets as well. Is there what was sort of the driver for that? Is that there's certain things that you see that you like, or I'm always curious. I mean, sometimes, there's sort of this. I mean, some of the markets in Nevada sort of have that, like, man, they're maybe a little more volatility than others. But what's your kind of view on those Nevada markets and kind of what your strategy is as you guys expand into those markets?
Yeah, so Nevada's been a market we've been in, or Las Vegas in particular has been a market we've been in for about a decade. We've been focused on it primarily in the single family rental market for many, many years. We started there going to the auctions back in 2010, 2011 and picking up houses, on the cheap. And so we've known the market very well. We're now transitioning and looking at it as a multifamily market that we want to expand into. And I think part of the rationale for it is that Vegas has kind of grown up finally in a way. It is obviously a tourist destination and tourism is a big component of it, but it's now become a real city in the sense that you now have these other industries that have come into play. You have tech, you have, all these other manufacturing logistics industries that have made Las Vegas their headquarters and whatnot. And so that said, we kind of want to ride that wave into rental growth, and it's also harder to build now in Vegas. It used to be, pick a piece of land and build on it, and it's less so that these days. And so I think that the long-term trajectory of a place like Las Vegas is going to be good for us, and it's going to be getting that near-term pop in rental growth where LA is sort of, at least at the moment, this sort of slow and steady approach back after COVID and kind of bringing rents back up. Vegas is like, hitting the ground running on rental growth. I think it's likely going to be the second highest rental growth market in the next, year or two. And so that's the other impetus, is to sort of mix and mingle our investment strategies so that we have, some near-term pops, we have some long-term pops, and we have this sort of mixed approach of bringing in cash flow.
Yeah. And do you, so when it comes to the fact that you guys are vertically integrated then, so on the property management side, because you had the single families over there, did you already kind of have presence on
Yeah,
that? Or were you, okay, you guys
yeah,
were,
yeah, yeah. Definitely. And that was the other reason. And, going back, to kind of our original intent in building this business was, we didn't never wanted to be promoters of things, kind of outside of our realm, and our ability to handhold a property and be vertically integrated and really be knee deep in our properties was a big key for us. And so, you won't necessarily see us going to new markets, across the country anytime soon, right? It's just not us. We're a very hands-on kind of group. And so Vegas was just something that was close enough, right? Close
yep.
proximity. We can get there pretty quickly. And we have a base of vendors and various people that we've worked with over the past decade. And so expanding that was relatively easy to kind of think through.
Yeah. And then you said like, the addition of the construction piece, I mean, how did that work before? I mean, especially with the deep value add, was that what you kind of ran into, is that trying to work through subs and things like that became, you weren't getting kind of the attention and love that you wanted? So you're like, we got to build our own crew, or is that?
In part, yeah, that was part of the impetus. The other impetus was that one of our partners that we just brought on a couple of years ago, he had had some pretty good success, and he's the one who brought his contractor's license over, and he had some pretty good success working with Zillow and Redfin and Open Door and some of those guys on unit turnover type work in the Inland Empire, and they were expanding now their operation into LA, and so he's like, look. I think there's a twofold approach here. One, there's this expansion of this business into LA, and I think we can get into it. And two, it will help us in building our own crew base so that we now can take those crews if, okay, they might be working on a house here or there for Zillow, but we also now have the ability to build our own crew to expand upon any of the buildings that we're doing on the multifamily side. And so it has worked in the last year. I mean, we've expanded quite dramatically on the construction side, and I see it continuing in the next year or two. And it will only help us on the multifamily investment side as well.
So in terms of like ways that you guys, so you acquire these assets, a good basis, kind of down to the studs, but when it comes to sort of like the amenities and the design and how you sort of attract then tenants. I mean, obviously that's a part of it. It seems as though you guys have maybe a different approach than some. I mean, just for as an outsider looking in, maybe you can give us some color on that, and just that component of it, like the vision
Right.
that's required then to see what the possibilities are. Who's driving that? Where does it come from? Kind of, and really, from your perspectives, like how does it change the outcome, right? Like I'm just curious, as it seems like that's a way that you guys are able to maybe get outside the box a little bit. That probably makes it a little bit easier to sort of uh, attract and retain residents and tenants in your buildings.
Yeah, I mean, I think that part of it is 100% my brother actually. He's heads up all of our design work, and he's in house obviously, and we've built an in-house design team around him, and so it's been great, having that ability to kind of have a design aesthetic that's our own. I mean, it's kind of remarkable. We have actually some investors who sometimes we'll do drive-bys on our buildings and kind of see, before they invest or even after they invest, and they're like, oh, I know which one is ours. It's like so obvious because usually we're buying in generally class B and C neighborhoods, and so our buildings stand out. They're the diamond in the rough, right? We go in there and we try and push the envelope in terms of the design aesthetic beyond what the neighborhood is used to seeing. And I think that a lot of the tenants who are prospective or already in place really appreciate that, right? They think that, hey, someone's taking responsibility for their building as opposed to the other buildings on the block that just are not being taken responsibility of, and so they're going to choose our building over others, right? And so that's another key ingredient of our kind of business model for sure.
Yeah, and do you feel too, to some degree, they're willing to pay a bit of a premium for that, like where they're like, that's a cool place, I want to live there because that's where the cool kids live. It seems
Right.
like that might be what happens.
Yeah, yeah, I would say so. I would say that's definitely the case. Again, it's a tenant base that unfortunately There hasn't been a lot of investment in certain parts of this of the areas that we invest in. In these sub-geographies in South Los Angeles and Long Beach and other parts. It's been disinvested in for decades, and now all of a sudden, we come in and we kind of clean things up a bit, and that's not only aesthetically, but also in terms of tenant base, right? We've had buildings before that have had some gang activity and other things, and we'll get in there and we'll really push the operational side and try and get those bad apples out. And a lot of the families that have been there for a decade are like, oh, we're so glad you guys are now owning this building and really able to clean it up for us. And so we've had a few instances like that as well.
Yeah. So what are the other sort of ways that you guys might do things a bit different than others? I mean, obviously you sort of target, there's a lot of guys chasing sort of 100, 150, 200, 250 unit buildings. You clearly, kind of fly below that radar. I mean, it may be driven in large part, where you are investing is more expensive. But maybe some other things you can share with us just about how you guys sort of mitigate those inherent risks. I mean, because clearly when you are taking things down to the studs, we talk about the vertical integration and the construction, and that's ways to sort of at least mitigate some of those risks that come along with rehab and that kind of stuff. But maybe speak to some of the other ways that you guys are very conscious about how you can ensure that the bad things don't happen, right? That those risks that are inherent are at least minimized or mitigated.
Right. Yeah. I think for the most part, that quality control and that in-house ability to kind of vertically integrate all the way from the heavy lift construction to the property management to the asset management is all in-house. And so that hands-on approach is probably key number one for sure in terms of risk mitigation. I'd say the other risk mitigation, which could be qualified as risk mitigation, is that when we're on the buy side, we're, like you were alluding to, we're kind of in the middle, right? We're not the mom and pop buyers, right? We're buying these smaller assets or selling these smaller assets. We're also not the institutional guys, right? And so we're in this kind of middle market space that I think we're able to kind of have a stronghold on because we have an institutional view or way of doing things, but we're buying a lot of times from the mom and pops. We're able to kind of get in there and say, hey, look, this is our price. We can go non-contingent, day two. We know what we're doing. It allows us to get a land basis that's maybe cheaper than some other folks would do. And I would also add that there are a lot of buildings that have issues, right? A lot of our purchases either have operational issues, challenges, deferred maintenance to the nth degree. And so your average other mom and pop buyer or even quasi-institutional group, they might have difficulty purchasing that building, but because we have the know-how and the financing knowledge and the sort of institutional view on things, we can get in there very rapidly. And so I think we've been able to build a base of sellers and brokers and in various sub-geographies within LA in particular that know us. They know that, hey, these are legitimate buyers who can buy a building and close this thing in 21 days because they've been there before and they can deal with these challenges. And so I think that's a risk mitigation in of itself, is being able to really push the envelope and buy at the right price, with our sort of ability that we currently have.
Yeah, I agree. And it seems to me that it does allow you, like you said, is that you sort of, the way that your strategy lines up where it reduces competition because, it's let's face it, I mean, multifamily is super competitive. I mean, it doesn't really matter, where you are these days. I mean, it is the hot ticket item, right? Like everyone's trying to become a multifamily syndicator. So and I think you hit on it, right, is that, and that even someone we call a mom and pop, mom and pop now is, they're running around saying I'm a multifamily syndicator. Mm-hmm. And so, and then those institutional buyers. So it is interesting where because that's all I hear all day long. Is everyone's like, man, we cannot find deals. There's nothing, the deals are hard to find. And it's, it makes sense, but it's that competition because everyone's hunting for the same thing. But to go in and say, well, this thing's going to be too rough for most people. Like they're not going to be willing to go there. And then to have the operational expertise, meaning you gear up for it so that you can go in, and not to mention then you get in at that right basis, which is, rule number one in real estate. It's like, don't overpay for the real estate, right? Get in at a good basis.
Yeah, and I mean,
You know,
I would give you an example that we're looking at right now. Actually, is it's a property in Northeast Los Angeles, a pocket called LaSalle Park. That's it's a 24 unit building, and there's 16 of the 24 units are currently vacant. The other eight have been approached about buyouts. It's a rent controlled building. There's the ability to also add ADUs to this, so it's a very complicated building, right? I mean, your average lender is not going to lend on that building. That's your first problem, and then your average buyer is not going to buy that building because of the the inability. You're going into a building with it more than half vacant, and you've got the other eight units that are likely, we'll see soon, non-payers or partly non-payers. And then the true value add is adding the ADUs, and so just all of those things combined weed out a lot of potential buyers, right? It's just, your mom and pops, your 1031 guys, your, whatever it might be, they're out, right? So it leaves like a handful of groups like us and maybe one or two others, in this particular subgeography that would buy this. And so at that rate, we can kind of whittle the price down to a reasonable rate because, hey, no one else is going to pick this up. It's just us. So that's what's
yeah.
helpful.
Yeah, it is. And that's where, I mean, I'm such a big believer in, like, especially as passive investors, you're really one of the key things. We always, you're hearing a lot more and more and more, right? It's like, pick the jockeys, not the horse, right? So it's obviously, and I'm a firm believer in that, right? It's like everything should begin with vetting the sponsors, the people that are involved. But as a part of that, I'm just a big believer in that you have to look for conviction. Like this discussion we're having right now, it's easy to have, and there's depth to it. There's a method to your madness. I
Hmm.
call it conviction. You have
Right.
conviction, right? It's yours. You own it, and you solve, and all the things that you do solve for owning it, right? Like, okay, we don't own the construction stuff, so we need to do that. We need to do the property management. We need to have in-house design. We need to do whatever, right? Like, this is where we live. We live in California because you have a lot of people. They woke up this morning in California and they're trying to buy properties in Tennessee, and they're trying to buy properties in Texas and Jacksonville, right, and the Carolinas. Okay, I'm not here to judge that. I'm just here to say, if that's the case, then I want to hear the conviction. How do they make that work? How do they know? I mean, and using Southern California and Los Angeles in particular, I mean, you got to know the neighborhoods. Like, you've got to know it intimately. And like you said, with the brokers and the agents, it always comes back to these are relationships that have to be developed. Relationships take time to build, to develop, all these things. And so when you're out there and you're talking to a sponsor, those are the things you're looking for. Like, do they have conviction? Is there a method to their madness? And then you go and apply that to the track record. Okay, so you're saying those things. Now let me see the evidence, right? And I think that's like with you guys. Everything we've just hit on, you and I haven't spent a ton of time having this particular conversation. But the thing is that I can see it through the evidence, right? Like, and of course I've seen all the information and I've reviewed, but I can see it.
Right.
Like, there's the fingerprints are all over it, right? Like, this is how you guys approach the world. This is how you do what you do. Um, and I think it's sort of an undervalued thing, or it's a thing that I think a lot of people, I think they overlook, right? Or like, as the sponsors, in terms of how they position themselves and their brand, it's like, it really does matter, because as the consumer, the person who's trying to develop a relationship with Golden Bee Properties or whoever it may be, I'm trying to figure out, what are you guys all about, right? What makes you different? Like, how do you do what you do? How do you create value, right? How do you ensure that you get not a return of capital, but a return on capital,
Hmm.
right? All sorts of things. And if it's like, today you're investing here and tomorrow you're investing halfway across the country, and you were into this property type and now you're doing that property type, to me, that's not conviction, right? And it's sort of a
Right.
red flag. You need to understand that.
Yeah. I mean,
Yeah.
I think to that point, it's I was having a meeting with one of our investors actually last night, and he he has the approach, but he can as a passive investor, right? Where it's sort of throw a bunch of darts up on the wall, see what sticks, and I get that, right? But as active GP sponsors on our side, we have to build a platform based on what we know best, right? We're the ones who are the fiduciaries of other people's capital for the most part. And so we have to
Yeah.
make sure that we're doing what we know best. And that's why I've always been a proponent of, I don't mind adapting, right? We got to be adaptable. We got to be agile. We got to be nimble and sort of roll with the changes of the market and, do things a little bit differently here or there. That said, it's got to stay within our kind of confines, our box of what we know best. And so, going to, like you're saying, going to a Dallas market, for us at least, and agreed, there are other folks who are based in LA who can do that left and right because they've been in that market, and that's just their thing. But for us, that was just never our forte. We were always about hands-on, vertically integrate, and really hold on to the assets in full and understand them and be able to drive them, be able to, all those sorts of matters. And so we've just built our platform around that concept.
Yeah, and I think there are certain markets too, like Southern California. It's literally probably. It's debatable, but it could be one of the best places to live on Earth. Independent of the political climate or whatever. But I'm just saying, like from a quality of life standpoint, let's be real. Is there a more even climate? Is there more whatever? So you have those factors, but when you think about that, so that's great to say like, hey, I'd love to live in LA. But when it comes to real estate, there's only so much dirt right around there. And I think that then a lot of those times when you have those convictions, it definitely drives. There's certain other things that become constants or things you can't change. One of them is, if you're going to invest or have exposure to Southern California multifamily like you guys do, it is more of a, when you really pan out and think about it, it's really more of, it should be a long-term hold, because if any dirt on this planet is, climate change aside, which I get could be a variable. So I'm just saying, as far as I can see, right, it's the sort of thing where it inherently, its value will just keep going up. And I think that's the beauty of real estate in general, but there's certain markets in the world for a variety of reasons that, in the Midwest or whatever, where you just don't see that you invest for cash flow primarily as an example. It's more cash flow driven, not appreciation driven. Right. So I think those are the other things that people need to understand. So to your point about the LP, that the investor you met with last night, that's the benefit of being an LP, is that you can build a very diverse, just in real estate allocations alone, it can solve a handful of different problems. You can create diversity by geography, by I want, income, and, you've got net lease stuff, and, you've got all these, you can kind of construct a portfolio that solves most of the problems your investment portfolio needs solved just through allocating into the real estate space, right? But when you think about opportunities like Southern California real estate, it really is the fact that it sort of has this built-in like capital preservation. As long as the people who are the stewards of the capital and operating it, are doing it right, that is kind of the benefit, right? Is that stuff just keeps going up and it's worth more and more and more and appreciates over time.
Yeah, I agree with you wholeheartedly. And, obviously I'm somewhat biased having grown up here and live here. And so I get that. But that said, I've always felt to your, your sort of juxtaposition of cash flow versus appreciation is that generally speaking, Los Angeles has both, which is great. That said, in recent years, that cash flow stuff and the yield has kind of been diminished because of cap rate compression and a few other things. And so that's why we have the approach of, okay, well, let's mix it up and let's say, okay, we know Vegas, let's throw in the cash flow in that kind of market, which is more cash flow based, but then that appreciation is really truly held here in LA. And so that mixed bag approach is kind of the way we get both, right? And I would say, and to your point about LA in particular, or Southern California, it's a highly supply constrained market, right? Building brand new is a near impossibility. Having been there. So that has its downsides, obviously, being a developer. But the upside, I suppose, is that as an investor and an owner of existing assets, that only means that those assets are going to appreciate even more, because you just don't have anywhere near the amount of supply. And I know in recent, last year or so, there's been a lot of media hype about, folks leaving California, and some of that may be true. But even it's a blip on the radar as compared to the amount of housing demand there is relative to the supply that's been backlogged for, I'm talking like decades. You go back to some of the data I've seen from the 60s, in which it was already at that point, there was more demand than supply, and it's only gotten worse. The chart's gotten further and further apart in the graphs. So So yeah, I think that market like Southern California, it's just it's a foregone conclusion that there's going to be appreciation over time. I mean, you might have ups and downs, here and there a
Yeah.
little bit, no doubt, but the long haul approach is just an upward momentum.
Yeah, I agree, and that's so true. It's overblown, and some of these articles now are coming out and sort of showing that it's completely overblown. The number of people that have exited California, or those who've moved from the Bay Area to Miami, it's literally it's a blip. It's the loudmouths on Twitter who are saying,
Hmm.
it's a handful of people who left. It's not indicative of like this huge trend, right? And so, yeah,
Yeah, and I
it's
would say anecdotally, even, I mean, we see obviously our own tenant base, right? We see people prospective tenants coming to our units and tenants who are leaving our units. And I would say that most of what I see, I don't look at it on a daily basis, but I do look at applications here and there. And a lot of times you have these people who were moving out. They're not moving out of California. They might be moving more to a suburban environment, let's say from an urban environment within the region. So you have a lot of that happening, I would say. And then you still have quite a few folks who are moving to California, to Los Angeles from out of state, which is kind of interesting to me. I'd say in the last couple of months, I've seen a lot actually from a variety of states, just a mixed bag. And, what's their rationale? Obviously, I would say more likely than not, it's a job relocation, it's a
sure.
job offering or whatnot. So,
Yep.
yeah, I agree with you. I think it's a little overhyped by the media.
Most definitely. That's exactly right. Cool. Well,
Yeah.
it's been great having you on. Where can people learn more about Golden Bee?
So, goldenbeeproperties.com is the best place to go. If you're interested in investing, got an email address, invest@goldenbeeproperties.com. I'm the one who responds to most of those emails, so you'll be chatting with me. Of
Cool. Awesome. Well, thanks for catching up, David. Appreciate it. You
course.
have a great day. Take
All
care.
right. Thanks, Lance. Appreciate the time.
Yep.